Now let's consider preparing a tax schedule for the project. So basically year-wise tax payments, right? Looking at scenarios of corporate tax as well as what MAT, typically what we call as minimum alternate tax. We'll talk about wherein we figure in minimum alternate tax as well as the corporate tax. So we'll look at year-wise kind of a schedule for that, and at the same time we would also focus on using the written down value method of depreciation rather than the straight line depreciation method for computing the tax. So keeping all these things in mind, it's better that we understand the whole process of preparing a tax schedule, because this is one more input that has to go into our P&L statement for the computation of our final profit after tax. So we will try to create using the existing P&L statement and making the modifications regarding the written down value method and the straight line depreciation method, arriving at the new particular value based on which we will be doing the computation of the tax. So what I'll try to take up is, we'll create one more sheet. We'll create one more sheet for tax computation. And because this is also an yearly kind of a schedule, I will keep the first two lines more or less the same. If this is equal to blank, leave it as blank, otherwise populate it with this particular value. So again, the first couple of years or couple of lines will remain the same, and I drag them until the column AZ to maintain consistency for each of the years. So this is what we are preparing, and of course now I would update the tax related stuff. So the typical tax related stuff which we would talk of is, we will start with PBT. See, as I said, we have to take the written down value method of depreciation rather than the straight line depreciation, which means what I was thinking of is, probably to this PBT add back this straight line depreciation and subtract the written down value method depreciation to arrive at the updated PBT. So based on that updated PBT, I can try out for the computation of tax. That updated PBT which is coming by taking the written down value method of depreciation into consideration is what is the taxable income for the company. So from that standpoint, we can very well consider, probably when it comes to the tax, I will simply say to the PBT add the straight line depreciation and subtract written down value method depreciation, and that is what I typically call as my taxable income. So based on which we will think of computing the tax rate. Alright. So what I can simply look at again is, if this is equal to O, then I am bringing in the PBT from this particular period. Otherwise, I am leaving this as blank. So this part is clear for me. The PBT is something which I am pulling out from my existing P&L statement, and all these are linked, so no problem at all. So this is my PBT, and wherever possible, probably until here, I'll put that formatting scenario, the number based formatting. So this is my PBT, and probably even this number based formatting I would go for highlighting the red. That would be much better. Okay, this is my PBT. I'm adding the straight line depreciation back. So if this is equal to blank, right, if this is equal to blank, I'm leaving it, or probably if this is equal to O, then only I'm adding back the straight line depreciation. So either from the P&L itself I can add back the straight line depreciation, otherwise I'm leaving it as the blank. So even for this period I'm able to highlight the depreciations which I'm going to add back. Right, this is the depreciation that is getting added back, and less the written down value method depreciation. So I'll simply consider, if this is the operations part, pull out the, from the depreciation, pull out the written down value method depreciation, otherwise leave it with a blank. So the written down value method is coming out to be something like this. So from here, what is coming out for me is the actual taxable income. So when I'm saying taxable income, again, if this is equal to O, I'm going ahead with the summation of these two and the negative of this. That is what is going as a part of my taxable income. So I'm computing here, this is blank, and going ahead it is working out like the taxable income in some years is negative. So the actual tax is applicable on these particular values. So whatever is the tax rate that we are talking of, it is applicable on these values. Right? The corporate tax rate is applicable on these values. So, and one more thing we have to be comfortable with is, here we have three scenarios to look at. In case of taxing, we talk about three scenarios. One, if the taxable income is less than 0, logically speaking, no tax is applicable. But there is one more thing, even though my taxable income is less than 0, if the PBT for that year is greater than 0, right? If the taxable income is less than 0, we have to check out if the PBT is greater than 0,